Is your memory your worst enemy? Hi, and welcome back to another Money Not Math conversation. It is Thursday, February 9th. Welcome back. I appreciate your time and appreciate you taking the time to watch this conversation or listen to it. And I look forward to the feedback you give, whether it's in comments or direct messages after you take the time to get through this one. I hope it brings you value. So thank you again. With that, like I said, is your memory your worst enemy? The reason why I'm asking is because people have memories, but markets don't, and that's a good thing. So for today's Money Not Math conversation, I'm going to be talking about how our memories can actually hurt us when it comes to our investing and financial planning practices. And to help me do that, I'm going to review an article from dimensional.com written by chairman and founder David Booth. So as David goes on to say, he says, one of the best things about markets is that they don't have memories. They don't remember what happened last week or last year. They don't even remember what happened a minute ago. Prices change based on what's happening right now and what people think will happen in the future. People have memories, markets don't. And he says that's a good thing because far too often we allow what happened in the past or what we remember to influence what we do in the future, even if it's not an accurate representation of what happened in the past or what's going to happen in the future. So as you continue on in 2023, take a lesson from the market. Don't begin this year bogged down by what happened last year. Give yourself the opportunity to start fresh. And that goes for if you haven't built a financial plan or if you have and you're updating it, start fresh. All right. Try not to let what happened in the past and the scars you've accumulated skew or hurt your ability to make educated decisions going forward or hurt your ability to trust your advisor going forward if they are a trusted person with a plan. Every day in publicly traded financial markets, David says, buyers and sellers negotiate prices for every stock and bond. To agree, they have to find a price that they both think is a good deal. This happens over and over, millions of times a day. Then it starts all over again the next day. Unlike people, markets don't think about the past. It's about today and expectations for the future. Markets must be forward-looking to set prices that entice buyers to buy. But prices can't be too low or sellers won't sell. Every piece of available information feeds into that decision-making process so everyone involved can agree on the price for a particular security at a particular moment. Markets are smarter and faster than you and me. Anyone who tells you that they know what's going to happen in the future, in my opinion, is either lying to you or lying to themselves because let's be honest, we don't know. All right. We can take models, we can take historical averages and all this stuff, but we don't know what's going to happen in the future. So what we have to just use best practices and build a plan that we can stick to. All right. With the expectation that the unknown will happen. Getting back to David's article, while you've been reading this, markets have probably factored in thousands of pieces of new information and adjusted the prices of thousands of different company securities just in the last 45 seconds. That's good news. Markets do the work so you don't have to. You don't need to believe in magic or be able to predict the future to have good investment experience. Some people might think I'm giving the market too much credit, but over more than 50 years in finance, David has come to realize that he is just being realistic. Someone described it to him as science-based hope. That's science-based hope. So basically, hope in the future based on the science of the past. Continuing on, David says academic research gives us insights into investing. Over the past century, markets have returned on average about 10% a year, although almost never that amount in any given year. So what he's saying there is that even though the market averages 10% a year, in US dollars, the S&P 500 index annual returns from 1926 to 2021 shows that almost no year is exactly 10%. So we have to understand that 3 out of 4 years of the market historically have been positive, but 1 out of 4 is negative. So we just have to expect randomness with the understanding that on average, it has returned about 10%. And the annualized inflation adjusted return on the US stocks is 7.3% going back to 1926. What does that mean? Basically, what he's saying here is, and you can go into a lot more depth, but just generally speaking, what he's saying is when you factor in inflation and the decreased value of the dollar, the stock market has returned about 7.3% after inflation. Okay. So because of big swings year to year, trying to time markets is a losing game. So don't try to outguess markets. Go with them. Come up with a plan, take no more risk than you can tolerate, and go spend some time with your loved ones. Investing has inherent risks. And no matter what anyone tells you, there are no guarantees. But if you don't have enough cash to live off for the rest of your life, what choice do you have but to invest? Control what you can control so you can set yourself up for success, and then give yourself some grace. Judge yourself by the quality of your decisions, not by their outcomes. There are so many factors outside your control that can impact investment returns. I think that is so important. I'm going to repeat it again. Control what you can control so you can set yourself up for success, and then give yourself some grace. Judge yourself by the quality of your decisions, not by their outcomes. There are so many factors outside your control that can impact investment returns. I believe one of the worst things investors can do is to impose their memory on their view of the markets, because then they might see patterns that aren't there and make choices that aren't based on research or evidence. It can, for example, last night I was curling, and I literally, I know this is not important as retirement planning, but bear with me. I completely missed a shot because I was still stuck on a shot that I had missed earlier in the day, and I overcorrected. In golf, we do it all the time. You're hitting a fade, you're hitting a fade, you're hitting a fade. You try to fix your fade, all of a sudden you hit a hook, right? Those are just sports, but people do it with their investing and their retirement planning all the time. Whether they took too much risk or not enough in the past, they take those historical feelings and they apply them to future actions. All right. So what we're saying here is build a plan with someone you trust, stick to the plan, and stick to the principles of the plan, not necessarily the outcome on a short-term basis. Getting back to David's article, it can feel daunting to develop an investment plan you can stick with and determine the level of risk that's right for you. But few things are more important than how you invest your life savings. That's why most people would probably benefit from a financial advisor to help them talk it all out. When it comes to investing, the key is not to try to outsmart the market, but to understand how it works and use that knowledge to your advantage. The market is a great information processing machine. It runs on human ingenuity, which is why returns tend to grow over time as people work to innovate and improve the value of the companies they work for. So start the new year off with a clean slate, or start your new financial plan off with a clean slate, or update your current financial plan with a clean slate, just like the markets do every day. All right. So thank you guys so much for your time today. Again, it's so important for us to ask ourselves, is our memory our worst enemy when it comes to our financial planning and other things in life, whether it's curling, golf, or otherwise? So please let me know what you think by commenting. And if you have thoughts about what you thought about this article, let me know. If you have questions, let me know. Or if you have requests for future conversations, please let me know. Vanessa Scadsam, if you watch this to this point, I apologize. I didn't do a Money Not Math on muffins. I thought about it, couldn't come up with anything creative, so I skipped it. But I promise to do my best if you ever have requests to make them applicable and valuable for you. So thanks again for your time. Hope you have a great day. And I look forward to seeing your guys' thoughts, and appreciate everyone who takes the time to like, comment, and share on my posts. Thanks. Bye. Almost forgot, as always, disclaimer, this content is not legal, tax, or investment advice. You should always consult a qualified professional regarding your personal situation.